So again, good afternoon. My name is Marley Crease. I am the head of corporate and investment banking at NCB Merchant Bank, Trinidad and Tobago Limited. And I'm very excited this evening because in collaboration with PSCU, Credit Union and Cooperative Society Limited, we're very excited to present to you this presentation called Becoming Stock Market Savvy. I hope that you'll all get a lot of value out of it and that you'll be able to walk away from this presentation with actionable items that you'll be able to apply immediately thereafter. So by all means, feel free to take note of any questions that you may have, and there will be a Q&A session at the end. So I would just like to start with a very short disclaimer that this presentation is for educational purposes only. We will not be making any specific investment recommendations, and nothing in this presentation is to be construed as or intended to be a specific recommendation for any investment or any company. Just want to get that out of the way in terms of some house rules. So about myself, I have been with NCB Merchant Bank and the NCM Financial Group since December of 2016, where I currently serve as the head of corporate and investment banking. NCB Merchant Bank, formerly known as NCB Global Finance, which is what some of you may have known it as, is a broker-dealer and non-bank financial institution regulated by the Securities and Exchange Commission, as well as by the central bank. And we are also the most recent member of the Trinidad and Tobago Stock Exchange. So just some of my professional highlights in terms of who I am and why I am having this conversation with you. I started my career in finance as a stockbroker in New York during the crash of 2008 at the height of what was called the Great Recession, life-changing experience. I have spent 5 years at the central bank as an analyst. I have 6 years experience in investment banking and accounting. As of November of 2021, I have a Master of Science degree from the London Business School, and I'm also a licensed stockbroker with the Trinidad and Tobago Stock Exchange. And in addition to all of the above, I am also myself an investor. I invest in the financial markets for my own capacity, I should say, and it's something that I would strongly encourage everyone else to do so as well. You don't need to be a financial professional or to have a fancy degree in order to invest. All it takes is a little bit of due diligence and some patience. So let's dive straight into it. So I'd like to start by dispelling some myths about the stock market. And these are ones that I encounter fairly often. And the first one I'd like to address is that investing in the stock market is like gambling. When people are skeptical of the financial markets, you may sometimes hear them refer to the financial markets as a casino. It is not. The reality is that investing in the stock market does carry some risk, but these risks can be managed. And the key is to understand the business that you are investing in, because when you buy shares in a company, what you are basically doing is you are buying a piece of a business. And if I go so far, I will say that not investing is the best savings, but the interest that you would typically get on those savings is probably not going to keep pace with inflation. And how you preserve your capital over time is not by taking your money and sticking it to the bank or sticking it under a mattress. Not that there's anything wrong with either, but by investing in instruments or in opportunities. And stock market investing is not the only way to invest, but to invest in things that are going to generate a return so that you beat the inflation monster, which is relentless. So I always tell people, and this is me speaking in my personal capacity, that the biggest risk you'll probably ever take when it comes to investing is not investing at all, because that persistent increase in the cost of living is going to erode your savings and erode your capital. How we manage this risk is by paying close attention to the companies in which we invest, understanding the financial markets, and making the single biggest investment of them all, which is lifelong education and learning about the financial markets and about investing in general. It never ends. I continue to learn new things every day, and I have been working in the financial markets for going on 13 years now. So that is the first myth I would like to get out of the way. It is not gambling. It is nothing like gambling. There is risk, but the financial markets are not a casino, and they should not be treated as such. The second myth I would want to explode is that investing in the stock market is for finance professionals with fancy degrees. Some people might find themselves intimidated by the financial markets. There's absolutely no reason to be. So professional investors can and do create value for their clients, but the reality is that individuals from all walks of life can and do educate themselves enough to be able to make smart investments that help them to achieve their financial goals. This may also involve seeking advice from financial advisors. However, I personally know of several investors who I would consider to be as sharp as any professional who have no formal training in finance. And one particular individual comes to mind, but I'm not sure if you would appreciate me calling his name. But I can say in my personal experience, working in finance going on 13 years now, that some of the smartest investors I've ever met are self-taught. They developed a passion for it, and they have done very well for themselves. So you don't need to be a finance professional. You don't need to have a degree from a name brand school in order to be a successful investor. The third one I would want to dispel is that investing in the stock market is somehow for big shots. I think among some people, although not so much anymore, there's this sense that, the stock market is for, large investors or rich people or people who have a particular, level of wealth, so to speak. And that is not true. You can open a brokerage account with most brokerage firms in Trinidad for a surprisingly small sum. And while brokerage fees do apply because the brokers make money on commission, it is possible to start at virtually any level of capital or savings that will be comfortable for you. You may not be able to walk into a brokerage firm and buy a single share of a single stock, but you do not need to be wealthy and you do not need to have substantial savings in order to start. You can start small and you can build over time and allow compounding and appreciation in the value of your investments to do a lot of that heavy lifting for you. So this is something I would have spoken to before, this idea that saving is somehow safer than investing. Interest rates have been low for over a decade and inflation is relentless. It erodes the value of your savings if not wisely invested. So when someone says to me that they have substantial savings or they have savings and they don't invest, what I would typically tell them is you are investing. You're investing in what I call the mattress fund, because you're basically putting your money underneath your mattress. Not the best possible return. The fourth one I want to speak to is that now, and now could be, interpret that any way you want, this idea that now is not a good time. So what I'm going to say next is basically an oversimplification, but it speaks to a larger truth. And it has been said that the best time to invest is 10 years ago. And the second best time to invest is today. And what I mean by that is that people sometimes look at financial markets, they look at the companies that are listed, they want to start, they're not too sure if now is a good time, maybe they should wait until the prices come down a bit, they're not too sure. The reality is that even among professional investors, it is extremely difficult to time the market, which is why one of the truisms of investments is that time in the market is worth more than trying to time the market. So of course, you would seek financial advice and try to identify those companies that offer good value in terms of the price at which they are traded. But this idea that there is a good time or not a good time to invest, it is very easy to use that as a justification not to invest at all. And then several years later, you're telling yourself, if only I'd gotten started sooner. So yes, there will be times when prices might be a bit overvalued. The markets are not efficient. They are subject to booms and busts, etc. But time in the market is worth more than trying to time the market. So I would always encourage anyone who is thinking about investing to avoid unnecessary procrastination. Do your research, do your homework, but don't allow yourself to be intimidated into deferring the decision to invest, because it is a common regret amongst people who always say that they wish they had started sooner. So let's talk about the power of investing. I want to give a practical example by looking at a handful of companies in particular. So today is November the 2nd, and I'm going to look at where certain companies were trading at on November the 2nd of 2016, exactly 5 years ago. So Massey Holdings Limited, and all of these companies are chosen because, one, these are household names that most people will recognize, and two, these are some of the best winners of the last few years in terms of price appreciation, and I'll get to another one very shortly. That one is not for a 5-year period though. So Massey Holdings Limited from $51.42 a share to $86.82 a share. Guardian Holdings Limited went from $13 a share to $30.50 a share. GMMB Group Limited from $86 a share to $2.24. Grace Kennedy, similar story, significant price appreciation from $2.55 a share to $6.24 a share. Now I'm going to speak a bit as to how these companies are quoted. So what you would see after the name of each company is what you would call the ticker symbol. And the ticker symbol would identify two things. It would identify the exchange on which the share is traded and the symbol that actually represents that particular company. So in each of these cases, what you would notice is that you would see the letters TTSE in front of them. So TTSE represents the Trinidad and Tobago Stock Exchange. JSE represents the Jamaican Stock Exchange. There's a slight error there next to Massey Holdings Limited. That should simply read TTSE, but that represents the exchanges on which these companies are traded. So some companies are what you would call cross-traded. They trade on more than one exchange. So for example, GMMB Group Limited trades on the TTSE, the Trinidad and Tobago Stock Exchange, as well as the JSE, the Jamaican Stock Exchange. Now, it's one thing to actually look at these numbers in the abstract, but I'm going to give you a fun example that allows you to really see it and touch it in terms of understanding the power of investing. So let us say that hypothetically, in 2016, I was considering buying a used motorcycle for 30,000 TT. And not just any used motorcycle, but a Kawasaki Ninja 300. What would have been the opportunity cost of such a purchase from an investment standpoint? In other words, if I were considering taking this particular course of action, what would I be giving up if it is that the alternative is to take that same money and invest it in any of these companies I would have recently described? So 30,000 invested in shares of Massey Holdings Limited as of the close of trading in November 2nd, 2016 would now be worth $50,653. If I had taken out 30,000 and invested it in shares of Guardian Holdings back in November of 2016, that would now be worth $70,384. Likewise for GMMB Group, Grace Kennedy Limited, a $30,000 investment in Grace Kennedy Limited in November of 2016, November 2nd to be precise, as of yesterday would have been worth $73,412. But of course, you know, cars, motorcycles, things of that nature, depreciate over time. So if I had taken that money and purchased a motorcycle instead, it would probably be only worth around $20,000 or $22,000 instead. So just to give you a tangible sense as to the power of investing, if you're willing to make wise investments and to hold over a period of time. Now, there's more to it than this. It's really not that simple. And I will be the first to admit that these companies were cherry-picked in order to whet your appetite, so to speak. So I'll give you one last example. In 2016, NCM Financial Group would have reorganized as a holding company, and it would have previously traded as National Commercial Bank Jamaica Limited. This is something that companies often do when it is that they would reincorporate a holding company and the shares of the holding companies would trade. So in March of 2017, it would have closed at $3.78 on the 16th of March 2017, and it closed at $8.06 as of November the 1st, 2021, which was yesterday. Now, there are some really important things here to take into consideration. Not all listed companies experience such returns. Share prices can and do decline over time as a company's fortunes change. Short-term fluctuations, or what investors would call noise, sometimes obscure companies' value and frightens away investors. And I would discourage people who are now getting into the financial markets to avoid short-term speculation and to think of yourself as being a business owner who is buying a piece of a business. You are a part owner. You can vote at the annual general meeting and you get a return not just from price appreciation, but also from dividends, which are payments that are declared at the end of the financial year by the board of directors. So where do we begin? I would say your first step is to understand the financial markets in general. So companies agree to list on a stock exchange in order to gain access to capital in the form of equity, particularly common equity, which represents the ownership of the company. So when you buy shares in a company, you are a part owner of a business. You are entitled to vote at the annual general meetings, and subject to the decision of management and the board, you might even receive a dividend at the end of the financial year, depending on how well the company has performed. So as an equity holder, you are compensated for the risk that you take, because as an equity holder in the business, you rank below the debt holders of the company. So the debt holders of the company will be institutions such as banks and non-bank financial institutions who would have loans, bonds, revolving lines of credit, commercial mortgages, and things of that nature. Now, if you invest in a bond that is issued by a company, you are a creditor. In a sense, you have lent money to that particular business. And for bonds and for loans and for those companies that have debt on their balance sheet, that would typically earn a fixed return for whoever would have issued that particular debt. However, equity is different. For equity, you have the opportunity to really participate in the upside of the business through appreciation in the value of the shares, and of course, the dividends that you would be able to earn as a source of income. So this speaks to what we call the capital structure of the company, whereby what we say, to use banker speak, is that the shareholders rank inferior to the debt holders, but they're compensated for that because they have exposure to the upside, which is the growth, the potential growth prospects of the company, in simple layman's terms. So in addition to ordinary shares, there are also preference shares, which rank superior to ordinary shares in terms of who has a claim against the earnings or the assets of the company. These preference shares are typically redeemable. They may have a fixed tenor. So for example, they may be issued for a tenor of 5 years, and they may carry a fixed dividend yield. So it might carry a fixed dividend yield of 6%, for example, redeemable by the company within 5 years, meaning that within 5 years of issuance, the company essentially has to honor those preference shares, redeem those preference shares, and investors would get their money back. Now, The dividends on preference shares take priority to payments of dividends on ordinary shares, which is why it's referred to as preferred stock or preferred shares. However, preference shareholders typically do not have many of the same rights and privileges of ordinary shareholders. So just to get a basic understanding of preferred equity versus common equity. So in terms of understanding the financial markets in general, I just want to give you an example. So what you're seeing now is an extract from the yearly equity report that is generated by the Trinidad and Tobago Stock Exchange. And this was the yearly report for the period January 2020 to December 31st, 2020. So this is last year's stuff. And they spoke about trading in securities in which some securities advanced, meaning that they increased in value. 24 would have declined, meaning that it dropped in value. And one would have traded firm. Trading firm means that there was no change in the price. And I'm going to explain to you what some of these indices mean. So in bold, you will see the composite index, the all Trinidad and Tobago index, the cross-listed index, and the SME index. So I'll begin first with what is an index. So an index is a basket of companies that is intended to represent either a market or a certain segment of a particular market. So for example, the Dow Jones Industrial Average is an index. The S&P 500, the Standard & Poor's 500, is an index that tracks the value of a basket of companies of 500 listed firms that represents the overall health of the US stock markets. So in Trinidad, we have our own indices. We have the composite index. We have the All Trinidad and Tobago Index, or the All TNT Index, which is specific to companies that are traded on the Trinidad and Tobago Stock Exchange. We have the Cross-Listed Index, which is specific to companies that are listed not just on the Trinidad and Tobago Stock Exchange, but also cross-listed on another stock exchange, for example, such as the Jamaican Stock Exchange. And we also have the SME index, which is the latest addition that speaks to small and medium-sized enterprises. And that comes out of an initiative by the TTSC in order to encourage other companies, other than simply the largest companies, to take advantage of the ability to raise capital that the stock market offers. So this is just a high-level overview of some of the indices that are typically referred to when we're talking about the financial markets in Trinidad and Tobago from an equity standpoint. So when they say that the cross-listed index declined by 18.3% in 2020, basically what they are saying is that when you look at a basket of shares that represents the companies that are cross-listed on the TTSC as well as the JSE, that particular segment of the market would have declined by 18.36%. And that is the purpose of the indices. An index gives you a snapshot of an entire segment of the market in a single glance. So in terms of stocks advancing, this is just straight from the stock exchange's website, and they show you which companies would have advanced, the volume that would have been traded, because of course, shares have to change hands, the value that is traded, which is basically just the price by the volume. And again, you can see the ticker symbols for some of these companies, all of which are household names. Likewise, for stocks that would have declined over the period, for the full list, you can go to that link on the stock exchange's website if you want to get a sense as to how the markets would have performed in 2020. And there's one firm, one company that would have traded firm over the period. So one of the things I would recommend if you want to start by getting a sense of things is start by poking around the stock exchange's website. They have tons of free resources available to you, including various market reports. So where do you begin? There are many cheap and in some cases absolutely free resources that are readily available. So, well, the newspapers aren't free, but by comparison, you can follow the newspapers, which you probably would buy anyway, and make a habit of following articles that are written about companies that are publicly traded with whom you probably do business on a daily basis. So for example, Massey Holdings Limited, if you shop at Massey, you have a sense of what it is like to buy products or services from that particular company. Many banks and brokerage houses release free research reports that are available online. You can find them on LinkedIn. They have them on their various websites. They are often fairly comprehensive, and they give you a good sense as to how professional investment analysts appraise the value of a company. And of course, there's also the stock exchange's own website. So there's a book recommendation I would like to make. I know some of the people in this audience may already be fairly advanced, but this is for a general audience that assumes no prior investment knowledge. I highly recommend the book Understanding Investments by Oran Hall. I think it's perfect for beginners. It assumes no prior knowledge, but unlike a lot of books out there, it is set against the backdrop of the Caribbean, whereas many of the investment books that might be available in a traditional walk-in store may be written primarily for the North American markets. And another option I would highly recommend is the Jamaican Stock Exchange eCampus Caribbean Securities course. So I myself actually did this year. Like the previous book recommendation, it is suitable for first-time investors, so people who are now getting into investing. However, I found it to be highly thorough, fairly comprehensive, but accessible at virtually all levels. And the Caribbean Securities course, which was put together by the Jamaican Stock Exchange campus, is very much grounded in the context of the Caribbean and in our local and regional stock markets. So if you're willing to take an extra step in terms of your financial education, I highly recommend this program. I myself recently completed it, and I can't recommend it enough. So the next step is to understand how companies grow and create value. And I'm going to run through these in no particular order. So firstly, of course, mergers and acquisitions affect shareholder value. In notes I have there that it's controversial because the research is a bit out in terms of whether or not mergers and acquisitions, or what they call M&A, actually does create shareholder value in the long run. But what it does do undoubtedly is it creates a lot of investor interest, both in the company that is being acquired as well as the company that is doing the acquiring. So mergers as a result of speculation, as a result of investors trying to determine whether or not the whole is going to be more than the sum of its parts, so to speak. Expanding into new markets and territories, another way in which companies can create value or add value to their shareholders. So if you look at a company, they're expanding regionally, maybe they're expanding into Guyana and South America, they're acquiring other companies overseas, they're establishing new trading relationships in other territories, that can be a source of shareholder value. Exploiting new technologies, also traditionally a source of shareholder value. New ways of doing business, even within a particular industry, another source of shareholder value. And we also come to the last two, how a company is positioned within its industry, and last but not least, the prospects for growth in that particular industry. So simply put, if the industry itself is a growth industry and a company is a market leader within that particular industry, then they have the wind at their back, so to speak. They're going to have a decisive advantage over their competitors in terms of their ability to create shareholder value. And of course, the industry itself is important. Not all industries, particularly in Trinidad and Tobago, not all industries are growth industries. Some of them are relatively mature. They can generate relatively stable cash flows, but the growth period has already passed. So these are some of the considerations when thinking about how companies grow and where value comes from. And a big part of investing is having a sense for where value ultimately comes from. So at this point, I just want to stop just to make sure that everyone can still hear me clearly.
Yes, we're hearing you. You're good. Yeah.
Okay, great. I just want to make sure I'm not talking to myself. So publicly traded companies are required to publish annual reports. They are available on the company's website. They are available on the Trinidad and Tobago Stock Exchange website, and they are often published in a condensed form in the nation's newspapers. So from time to time, when perusing the newspapers, you might see the condensed, consolidated financial statements of a company, typically as an insert. And that would typically involve a short management discussion and analysis, or maybe an address from the chairman of that company. And that section gives you a useful high-level overview of not just the company's recent performance, but also the strategic direction, as well as the company's short-term and medium-term goals. So what I always recommend to anyone who is now starting out is, after you have grasped the fundamentals, if you want to get your feet wet in terms of starting to look at companies, pick one company. Pick one company that you think is familiar to you because you interact with it on some level, and just spend some time getting to know that one particular company. And when you read articles or you read the annual reports, put on your owner hat. Put on that hat that says that I am a potential investor in this business. I am a part owner of this business, or I will be if I decide to invest, and that therefore I, along with the other investors, have the ability to hire and fire the CEO. Because at the end of the day, if you are a shareholder in a business, the chairman, the directors, the management of the company, they all work for you. Maybe not only you, but they work for you. And last but not least, the financial statements, primarily the balance sheet, the income statement, the cash flow statement, and the statement of changes in equity. That provides more detailed insight into the financial health of the company, but I have a big caveat here: watch out. Past performance is no guarantee of future performance, but it is a start. So there are some simple questions that anyone can ask, and you don't need to be a financial wizard, and you don't need a calculator or an Excel spreadsheet in order to ask yourself some very simple questions before looking at any company. Are they likely to be around in 20 years? I think that one is fairly self-explanatory. Do they provide an essential service, for example? Are they still growing, expanding, or creating new products or services? And last but not least, if it's a good company that is growing, expanding, and creating new products or services, and they're likely to be around for another 20 years, then this brings us to, is current price reasonable? Would you be getting good value if you were to buy shares of that particular company at that particular price at that particular time? And this goes back to what I was saying earlier about it's very, very difficult to time the market. But if you have a sense as to a company's intrinsic value, you might be able to make an assessment as to whether those shares are overvalued. This brings us to understanding the language of valuation. So it is beyond the scope of this presentation to teach a class on valuation. That could be a class by itself. But there is something to be said for understanding the terminology so that when you are reading analyst reports or you are party to conversations where people are talking about companies and how companies are valued, you can participate in the conversation, if not be able to follow. So just some commonly used terminology. So earnings per share, which in layman's terms would be the retained earnings of the company per common share. You have the price earnings ratio, which is considered a bit of a quick and dirty valuation metric, which is basically the share price divided by earnings per share, and is typically done on what you call a trailing 12-month basis. And people use PE ratios a lot in shorthand conversation for shares, because company valuation is subjective. So any company that you're looking at valuing is typically compared to a basket of its peers or its competitors. So to give you a simple example, if you are looking at a publicly traded company that is a distiller or that is in the market for producing beers and liquors, etc., and they are trading at a price earnings ratio of, let us say, 8 times earnings. When you compare that company to a basket of their peers, a basket of their competitors, you might realize that its competitors might be trading at 10 times earnings or 12 times earnings. And then you have to understand why. Is it that this particular company is being undervalued? It is a very high-level introduction to this particular topic, but it gives you an ability to compare one company to another or to a basket of companies in the same industry and see how they stack up in terms of how the share price for that particular company is trading relative to the earnings per share of that particular company. And as a general rule, companies that are high growth are able to get away with much higher PE ratios, as they referred to. The third one, I won't go into any detail at all. There can be a class by itself. This is valuation in the form of discounting cash flows. So basically, the premise behind DCF valuation is very simple, that the best way to determine the value of a company is to forecast the future ability of the company to generate free cash flow, and then to apply a discount factor to each of those cash flows in order to arrive at the present value of that equity. That is it in a nutshell. And the idea is basically that $1 today is worth more than $1 tomorrow, or what is known as the time value of money. There's more to it than that, but I just wanted to give you that high-level introduction. EBITDA, or earnings before interest, taxes, depreciation, and amortization, another commonly used term. It is a rough indication of what you would call the core earnings of a company. Depreciation and amortization are what you would call non-cash expenses. So they are expensed and they're treated as expenses on the income statement, even though it's not an actual cash accrual. And of course, by looking at your earnings before paying interest on debt, before taxes, before depreciation and amortization are deducted for expense purposes, you get a sense as to what the baseline operating earnings of the company may be. So you'd hear people talking about EBITDA and companies trading at a particular multiple of EBITDA. And that is what this is referring to and why it's commonly used. There's another one called total enterprise value. It's a valuation measurement that is used to compare companies with varying levels of debt. So the total enterprise value in simple terms would be the total economic value of the company. And it takes into consideration not just the equity value, but also the market value of the company's debt, any loans or bonds that they may have issued, while subtracting out cash and what you would call cash and cash equivalents. And when doing comparative valuation using what we call multiples, one of the multiples that you would hear analysts refer to would be TEV to EBITDA, where TEV is obviously the numerator and EBITDA is the denominator. So this is just some of the terminology that you're likely to encounter in conversations about companies and company valuation and trying to get to the bottom of what a company's equity is really worth. Because at the end of the day, you can have a great company, but you may not want to overpay for it. So understanding the language of valuation, reading the book I would have recommended earlier, if you want to invest further in your financial education, maybe taking the Jamaican Stock Exchange e-campus Caribbean Securities course would cover all of the above and more. And of course, these are standard concepts across finance. So you can always go on investopedia.com, another great resource where many of these there's a lot of room for subjectivity. It is often taught as a standalone class by itself because of the intricacies involved. It involves a bit of financial theory, it involves a bit of accounting theory, but don't be intimidated by this sort of language. And the reality is, you do not need to be able to create sophisticated valuation models in order to spot good opportunities. And you can learn a lot by reading professional analyst recommendations, some of which are made freely available online. So analyst research reports typically would carry a buy, sell, or hold recommendation based on the price at that particular point in time. So I'm not going to pick on any company in particular, but ABC Brokers Limited might issue a report on the XYZ company, and they would say that the XYZ company is currently trading at around $50 per share. We believe that the fair value of that share should really be 60. We believe the company is therefore undervalued, and therefore we are issuing a buy recommendation. The reverse is also true. A company or an analyst at a brokerage firm might do a research report on a particular company, and they may note that based on all of the factors we've mentioned before and the economic environment and their own internal models, maybe they believe that the company is trading above the fair value of its equity, in which case they may issue a sell recommendation or maybe a hold recommendation if they think that the currently traded price is more or less in line with the market. And it's worth mentioning that these reports are time sensitive because, of course, a company is very much like a living, breathing thing. It continues to evolve, for better or for worse as time goes by. So the usefulness of an analyst's research report has a fairly short shelf life because market and economic conditions are always in flux. So just some observations on valuation. The big thing I would want everyone to take away is that it can be subjective. There are common industry standards for valuation, but there's a fair amount of room for the individual analyst's input. So if you want to read analyst research reports to get a professional opinion on a particular company, what I would say to you is, if the same company is being covered by different analysts, read all of them and decide for yourself, because even the experts get it wrong. So you've learned about the financial markets, you've been reading the reports in the newspapers, you've started following the annual reports of publicly traded companies, maybe you've taken a course on investing and you've decided that you're ready. Maybe you have some funds put aside and you want to get started. Well, to start, you open a brokerage account. You would typically need 2 forms of ID, a utility bill not more than 3 months old, and of course, each broker is going to have what are called know your customer requirements and account opening forms. Some brokerages might have minimum opening balances. So for them, they might tell you, for example, that to open a brokerage account and to start doing your first trades, they may require a minimum account balance. So for example, maybe it's 2,500, it could be less, it could be more. It varies by the brokerage firm. As I would have mentioned earlier, many brokerage firms themselves also employ their own in-house investment analysts who will provide research reports to you and trading recommendations to you free of charge. Read them, but take them with a pinch of salt. And this comes back to my previous slide. Form your own opinion, because even the experts, quote unquote, get it wrong. So how it works is our brokers trade on your behalf in return for a commission. That commission is typically calculated at a percentage of the total value of the transaction. The brokers are members of the stock exchange. The stock exchange will then charge the broker a fee. And in terms of who these brokers are, there are 7 brokerages listed as members of the Trinidad and Tobago Stock Exchange, licensed to deal on the TTSC. And I am proud to remind everyone currently in attendance that NCB Merchant Bank Trinidad and Tobago Limited is the newest member. We are licensed stockbrokers. We are a subsidiary of NCM Financial Group Limited, which you may recall earlier from a previous slide when I was spoken about, where NCM Financial Group would have traded as of November 1st. So just to let you know that, we are in this business as well. I myself am a licensed stockbroker. This information you're seeing in front of you is actually taken from the stock exchange's website. And we are very much open for business in this particular area in terms of being able to process trades and open brokerage accounts for our clients. So that concludes the formal part of my presentation, but there's something that I do want to address because it's very topical, and it has to do with cryptocurrency. So what is cryptocurrency? It's basically a digital currency that can be used to buy and sell goods and services. It is supposedly protected from counterfeit by using cryptography technology. They're typically unregulated by any central bank, and they use what is called blockchain or distributed ledger technology, whereby the information is orchestrated in such a way so that there's no central registrar. That makes it extremely difficult for the registrar, the transaction registrar, to be hacked, for it to be cheated, for it to be modified. And it is revolutionizing how payments are being made in terms of how funds are being transferred, and there are other applications as well. So it's very much a hot topic. People talk all about Bitcoin, the other cryptocurrencies, and it falls outside of the scope of this particular webinar, which is really about the stock market, but I get questions about it all the time. So this is just an extract from the Euromoney Learning website about some of the properties of DLT or distributed ledger technology. But from an investment standpoint, is cryptocurrency a wise investment? Well, I would have certain questions. How do you value a cryptocurrency? What are your individual investment goals? And if you invest in a particular cryptocurrency, how transparent is your investment? Do you understand exactly what it is that you're buying, how it is priced, and how it generates value above and beyond its ability to increase simply because more people are willing to buy? So here's my take on this. High-risk asset classes, and I would consider cryptocurrency to be relatively high risk from the standpoint that the variance in the expected return can be significant. High-risk asset classes can actually reduce a portfolio's overall risk profile as part of a balanced portfolio. And I won't get into this now, but this is what is known as modern portfolio theory. And this is because some asset classes, such as cryptocurrencies, maybe it's Bitcoin, maybe it's something else, they may have very little correlation with the other assets or the other stocks in your portfolio. So as part of a diversified portfolio, I have no issue with it per se. I think the problem arises when novice investors take large concentrated positions in order to speculate in things that they don't completely understand. So what I would say is, with regard to the subject of cryptocurrencies, by all means, educate yourself in this area, but master the fundamentals first. And my final thought for the presentation is that one of the best investments you will ever make is an investment in your financial education. It is a lifelong commitment, but it's very, very rewarding and you never stop learning. Read, explore, discover, but most importantly, invest. So at this point, I would want to open it up for question and answers.
Hi, Mr. Chris. So yes, we have quite a few questions and we have a couple hands raised. So I will start with the questions and then we'll go to those who have their hands raised.
Sure.
First question for you, and you can probably stop your share so that we can have you full screen. Is NCB Merchant Bank related to FCB?
No, there's no connection whatsoever between those two institutions. So NCB Merchant Bank is a subsidiary of NCB Capital Markets Limited. NCB Capital Markets Limited is the investment banking and wealth management arm of the NCB Financial Group, which is also cross-listed both on the Trinidad and Tobago Stock Exchange and the Jamaican Stock Exchange as NCBFG. FCB is a separate institution altogether.
Okay.
So to answer that question, NCB Merchant Bank Trinidad and Tobago Limited is a subsidiary of the NCB Financial Group, which is headquartered in Jamaica, but has subsidiaries and operations throughout the Caribbean.
Next question. Do you think that investing in mutual funds, conglomerates like ANSA and food and beverage businesses like Massey and PHL are good shares to purchase? Manuel has noted that, but Massey in particular has grown since the pandemic.
Okay, so I am tempted to answer that question, but as part of my disclaimer, I would have mentioned earlier that it is not the purpose of this particular webinar to give any specific investment recommendations or investment advice. So what I would say in response to that is consult a financial advisor, decide what level of risk is comfortable for you, and get a second opinion. But it's not really within the scope of this particular conversation to issue anything that could be construed as an investment recommendation. I know that's a bit of a letdown in terms of a response, but I do need to be careful in terms of how I answer certain questions.
Totally understood. Is this the same as Forex trading?
No. So Forex trading is foreign exchange trading, whereby people buy and sell foreign currencies in order to earn a profit. Typically, that is done with a fair amount of leverage in order to increase the returns. Foreign exchange trading is really more about speculating on currencies. So for example, someone might have a trading account and maybe they are trading the pound against the US dollar or the Swiss franc against the US dollar or things of that nature. That is currency trading, which is separate and apart from stock market investing.
Okay, what is the process for someone in Trinidad to trade on foreign stocks, example, US stocks?
Okay, good question. So there are local brokerage houses based here in Trinidad that do offer that particular platform, whereby they have relationships with what are called prime brokers based outside of Trinidad and Tobago, who would then offer local institutions access for their retail clients, for them to be able to buy shares that are listed on foreign exchanges. So again, I would not want to call names because I would not want to, call anyone out, but there are brokerage firms you can go to right here in Trinidad that are based in Trinidad, whereby you can open brokerage accounts and tell them that you are interested in investing in companies that are listed on foreign exchanges. What I would say to you is that, of course, it would require US dollars, and more often than not, you would have to provide your own. But yes, it is very, very possible to approach local brokerage firms who offer that particular service and say to them, I'm interested in buying shares of, Apple or Tesla, for example, and they can arrange that for you because they have external relationships with other institutions that can facilitate that order flow. So yes, this is very possible.
Okay, how important is technical analysis in determining what company to invest in?
Okay, so I like this question because it's something that I used to read up on a lot at an earlier stage in my career in finance. And what I would say to you is this: technical analysis is a little bit controversial because it's undecided as to whether or not it actually works. So if you're into technical analysis, you spend a lot of time analyzing charts and analyzing patterns, breakout patterns, support, resistance, head and shoulders, different other patterns that are supposed to indicate that a share is supposed to appreciate or depreciate based on institutional buying patterns. What I would say to you is that technical analysis is good to know simply because so many other people believe in it, but the research is out as to whether or not it actually works. So the people I know who use technical analysis, primarily for the international financial markets, where those markets are large and liquid, they may use technical analysis in order to determine an entry point for a company in which they have already decided to invest. But amongst sophisticated institutional investors and professionals, technical analysis is not that widely used anymore, but it continues to be very popular among what we would call retail investors, individual investors who have been sold on the idea that all you have to do is memorize a few basic patterns and you can become the next George Soros or Warren Buffett. But it doesn't work that way in practice. There's a lot more to it than that. So with technical analysis, good to know, by all means, as part of your financial education, but take it with a pinch of salt.
All right, we're gonna go to two more typed, then we're gonna address those with their hands raised that would like to voice their question, and then we come back. Questions are coming in. How do you buy stocks from these companies? Is it advertised?
Brokerage firms, I won't say they advertise the way other companies might advertise, but they do run promotions and they do put their name out there. So for example, what I am doing here is basically, I'm here talking about investing in the stock market, etc. But I'm also putting my company's brand out there. So they typically would not advertise a stock the way courts might advertise a special or things of that nature. They may advertise their services in general, and if they have in-house investment analysts, those investment analysts would generate research and put it out there free of charge. So that is how they would typically go about it. Many brokerage houses would sometimes write articles. So you might pick up the Express or the Guardian, and you would see an article that was written by an analyst at one of these brokerage houses. And that is basically part of their marketing, so to speak. But in terms of how you go about actually doing it, you simply go into any one of the brokerage firms, you ask them what their account opening requirements are. It's typically 2 forms of ID, a utility bill. You have to fill out some account opening documentation, maybe a source of funds declaration, and they may have a minimum amount to get started. And once you meet those requirements, then it's up for you to tell them what it is that you want to invest in. Although if you're not sure where to start, your broker or your investment advisor may sit down with you, do a needs assessment, and determine what may be appropriate for you based on the reason that you have for investing, your time horizon, and your risk tolerance. And then they may be able to recommend something that they think may be appropriate for you. So brokerage firms don't advertise in the way that a store might advertise. They do branding and awareness work for their respective brands, but essentially you just go in, you open an account, and if you want to trade on your own, fine, but they typically have someone there who is also only too happy to guide you.
Okay, What are the advantages of buying cross-listed stocks?
Okay, very good example, very good question. So part of the reason why companies want to list on an exchange in the first place is for something called price discovery. Price discovery is the mechanism whereby when you have many buyers and sellers interacting in a market, the bigger that market is and the more buyers and sellers you have interacting, the more likely it is that the price that is quoted on any given day represents a broad consensus as to where those shares should be trading. So for example, in the US, if you look at a publicly traded company such as Apple Computer, for example, they have millions of investors buying and selling those shares every single day. So what you have there is transparent price discovery. In the Caribbean, however, our markets are much smaller. So if you were to look at the newspapers and you were to look at the daily traded share quotations, what you would observe is that there are some days in which certain shares may not change hands at all, or the volume might be very low. For cross-listed shares, what that does is the pool of investors who buy and sell in that particular share becomes significantly larger. And as a result, in theory, the pricing of those shares should be more efficient, and it should be more transparent, and it should be more liquid. So I'll explain to you what I mean by liquid. If you are buying shares that are traded on the New York Stock Exchange, for example, using an online platform, you may be able to buy and sell volumes at pretty much the click of a button, because there are so many other sellers out there that the settlement is very, very fast. In the Trinidad and Tobago Stock Exchange and the local stock exchanges, our markets aren't that big. They're not as liquid. So if you have a large buy order, your broker might have to wait a while until there's a corresponding sell order that matches the price at which you want to buy. That is what I mean by liquidity. So for cross-listed shares, in theory, they benefit from greater liquidity, because it's not just investors in Trinidad who are looking at buying and selling shares in this particular company, but also investors in the cross-listed exchange on which those shares are also traded. So to give you a simple example, Guardian Holdings Limited was recently cross-listed. So GHL is now listed both on the Trinidad and Tobago Stock Exchange as well as the Jamaican Stock Exchange. So the pool of investors who would be able to buy and sell GHL shares on any given trading day has been expanded, because it's now not just Trinidad, but also Trinidad and Jamaica. So I hope that answers your question. It provides a bigger pool of investors. The pricing is more transparent, it's more efficient, and the shares are more liquid, meaning that if it is you have a sell order, you stand a better chance of being able to get a matching buy order in a reasonable time frame. And the opposite, if it is that you have a buy order, you stand a better chance of being able to get a corresponding sell order in a reasonable time frame, simply because there's more activity in that market.
Okay, Mariel Gibbs, you had your hand raised. You can unmute your mic. Mariel?
You are still on mute.
All right, while we wait, she's coming. Okay, Mariel?
I'm sorry, yeah. That was a mistake. I apologize.
Okay. Yolanda, you had your hand raised.
My hand was raised, but I took it back down because I'm still formulating my thoughts.
Okay, no problem. All right. Next question for you, Mr. Chris. What are your thoughts on apps such as Robinhood and using it as using it as someone new to beginning to trade?
I would say proceed with caution, and I'll explain to you why. Apps such as Robinhood, there is nothing wrong with them per se. They provide ease, they provide convenience, because in the old days, if it is that you wanted to buy shares, you had to pick up the phone, call your broker, the broker would put through the order, it will settle sometimes 3 to 5 business days later, what you call T+5, and you have to wait to get a trade confirmation in the mail. You know, that's in the dinosaur era. But now, with apps such as Robinhood, they offer you the ability to trade very, very quickly from virtually any smart device. And they offer lots of incentives for doing so, and they make it very easy to do so. The challenge with that for beginner investors is that if you don't have a disciplined investing approach, what could very well happen is that you can find yourself engaging in impulse buying and selling. So there's nothing wrong with the app itself. It's simply a tool, but it is a tool that can be misused.
All right, question from Cheryl Lynch, and Cheryl, you will tell us if this is why you also had your hand raised. Would you advise someone to start a watch list while you decide which company to invest in?
Absolutely, absolutely. And the stock exchange website actually allows you to do that. And one of the best ways to get started is to shortlist a handful of companies, whatever you think you can handle, and just start following them. Just start following them. Any news articles, any reports, any changes or fluctuations in the price, because getting to know a company is a lot like getting to know a person. So if I were to use a dating metaphor, so to speak, you can have a pool of potential companies, and you're getting to know each one until you finally decide that you want to pull the trigger and invest in any particular one, or maybe even all of them. But getting to understand how a company creates value for its shareholders, it's a process, and it's a process that takes time. So creating a watch list helps you to do that, and I would absolutely recommend that.
Okay, final question, and Glynis, I see your hand raised, but I know you also posted some questions, so let me know in the chat. Is investing in an IPO a good opportunity?
It can be. It absolutely can be. There are no guarantees with regard to initial public offerings, but there can be great opportunities investing in an IPO for the right company. So I would not say that IPOs are always a good opportunity, because it depends on the individual company. It depends on how the IPO is priced. It depends on how long you intend to hold those shares for. But yes, investing in IPOs for the right company can be a wise investment, but it depends on the company, of course, and it depends on how the IPO is priced. Because once it's actually brought to market, the market takes it from that point, and it's the market, that interaction between buyers and sellers, that determines what it's going to trade at. But the initial pricing offer is really determined between the company and their investment bankers in terms of trying to do the valuation and determining what these shares should be issued at when they first come to market. But to answer your question in brief, investing in IPOs can be or do present good opportunities, but with all things, it's subject to due diligence, and make sure you understand what you're investing in.
All right, Mr. Chris, I know we are a little over time, so tell me what your time is like. 2 questions just came in. Are you good to take them?
Yeah, sure, by all means.
Okay, great. How long does it take to sell a stock? Is it based on demand for your stock?
Yes, yes. So I'm going to give everyone a little bit of homework, right? And pick up a newspaper tomorrow, Express Guardian. It could be digital, doesn't have to be the physical thing. And there's typically a section in there that speaks to the daily trading quotations for companies that are listed on the exchange. And as you go through the rules, what you would realize is that some shares have more volume than others in terms of the number of shares that change hands on any given day. So for some shares, which I won't name, there isn't much liquidity, there isn't much activity in that particular share. And when those shares do change hands, they may change hands ever so often, typically because some large institutional asset managers reallocating their portfolio. But if you are holding a share that is relatively illiquid, it's not in particularly high demand, you can have challenges getting your shares sold depending on the amount that you want to sell and depending on the price that you insist on selling at. So yes, the short answer is it absolutely does depend on the demand for your stock in terms of its liquidity and the extent to which there's an active market of buyers and sellers for that particular company's stock. In terms of how long it actually takes, it depends on the amount and it depends on the share. But unless you are talking about very large amounts in terms of, institutional investor type amounts, chances are that may not be the concern. It might primarily be more of a pricing concern in terms of what you are willing to sell at or buy at. I hope that answers your question.
Okay, Ms. Hines? Leanne Hines, you had your hand raised?
You are on mute.
Yes, hello.
Yes,
Hi.
good evening.
I just wanted to get your thoughts because I, at a point in time, was interested in looking at a company in South Korea to invest in, a new IPO that launched last year. And I wanted to find out your thoughts on the Asian stock exchange and if there's how difficult or what are the different steps someone might need to take to get into that avenue.
So it is much easier now for a Trinidadian sitting in Trinidad to be able to buy shares that are listed on exchanges worldwide, because there are brokerages here in Trinidad that have relationships with overseas brokers whereby they offer that particular service. So if it is you go to one of these brokerage firms, they may tell you that they have a trading platform whereby you would fund that trading platform. They work with another prime broker who is based overseas. So if you want to buy shares that are traded on a number of different exchanges, naturally, of course, as long as you have the US dollars to settle, then they can facilitate that for you. And they can either advise you or they just give you the trading platform and you absolutely make your own trades. There's also the option of going through a company like Interactive Brokers where you deal with them directly. So it is possible, it is doable, and more people are doing it. I would simply caution, make sure you understand what you're investing in. But it's definitely possible. As a matter of fact, in the old days, there's one particular platform that comes to mind. They allowed users of their platform to buy shares that were traded on up to 16 different exchanges. So it's a lot easier now than it was 10, 15 years ago.
Okay, this will be the final question, and then waiting in the wings will be Market Manager at PSCU to close us off. So the last question to you is, do you know if you can use stocks as a security for a bank loan, or is it too volatile?
Yes, you can. Yes, you can. So these are what you would call margin loans. You can use shares as collateral. Not every financial institution has tolerance for that sort of risk. So for those brokerages or non-bank financial institutions or banks who are willing to lend against shares, what they would typically do is that they would require a margin. They would require, in layman's terms, a top up. So if it is that you own shares of a publicly traded company and those shares are worth, let us say $50,000, and you want to borrow against those shares, what a financial institution may do is that they would say that we are going to apply a margin. So we are going to lend up to maybe 50 or 60% of the value of those shares, but we would take a charge over those shares, and that charge has to be lodged with the Trinidad and Tobago Central Depository, representing the banks or financial institutions' claim over those shares. And the reason why they do that is because, unlike other traditional forms of collateral, such as land, buildings, real property, the market value is a lot more volatile. So you absolutely can borrow against shares, but it would be at a margin meaning then that the bank or financial institution is only going to be willing to lend up to a percentage of the market value. And if it is that the market value of those shares were to drop below a particular threshold, you may get what is known as a margin call, whereby you get a call from your bank or from your broker stating that the price of ABC shares has dropped by, let us say, 20%. Our collateral coverage ratio has now dropped below the required threshold, and therefore you are required to either post additional shares or post cash in order for that collateral coverage ratio to be normalized. So that is how that typically works. But the short answer is yes. Not all financial institutions offer it, but many do. You can borrow against shares.
Great. On that note, thank you everyone so much for your questions. I would like to invite Mr. Elvis Alec to share some information from PSCU before we close off.
Sorry, I'm now unmute. Hi, good evening, everyone. First of all, I would like to thank Mr. Chris for sharing with us such a knowledgeable and informative session. I'm sure everybody was looking forward for this session, and it was quite an interesting one. And the reason I have joined this session and came to take a few minutes of your time to talk about here is if any of our members or if anybody who's logged in at the moment and who are willing to apply for a loan to invest the money in the stocks, you are most welcome to apply for a loan. The normal regular conditions will apply for borrowing the money, and you can call us and we will do an assessment on based. It all depends on how much money you are looking for to invest in the stocks and how much, depending on your situation, we can grant you. But the loan money for investing in stocks must go through a brokerage firm. So that's all I wanted to make mention of. We have like number of products, so feel free to call us, and we'll be more than happy to lend you money to invest in stocks. You must have a clear plan of action before applying for this investing in stocks. And thank you all for joining. And I just have one question from Mr. Chris. I'm seeing a lot of questions coming in, right? If our members are allowed to email the questions, then you can answer them via email.
Sorry, can you repeat that again?
If we can send you the questions via email, because we have members who have a lot of other questions as well. So you may not be able to address all of them right now. If we can email you all the questions.
Send me an email with all of the questions, and I will respond.
Okay, thank you so much. Thank you so much.
Okay.
Yes.
All right.
Well, thanks again, Mr. Please, and thanks to all our members who would have taken time to join this session. Yes, go on, Tisha. Yes.
I was doing that. I was just saying thanks, and just to advise everyone is asking about the recording. It will be on the YouTube page, right?
Yes, it will be on YouTube. Yes.
Right. Great. So thank you again, everyone. The recording will be uploaded to PSCU's YouTube page if you would like to have a rewatch of it. So thanks again and enjoy the rest of your evening.
All right, everyone. Do have a good evening.